Welcome to The Explainer. Today, we're going to dive deep into the world of algorithmic pairs trading. It's this incredible strategy that takes all that market noise and tries to find a real tradable signal. It's a story about how a century-old hunch from a legendary trader evolved into a high-speed, data-driven quest.
Okay, so let's get into it. The whole thing really starts over a century ago with this kind of legendary trader named Jesse Livermore. And the guy was supposedly, well, lazy. He wasn't interested in being a bull or a bear. He just wanted to be on the right side of a trade, no matter which way the market was going.
You have to remember, back in the early 20th century, doing any kind of analysis was this grueling, manual process. I mean, you literally had to draw stock charts by hand. Livermore thought this was just incredibly tedious and wanted a shortcut. He wanted a strategy that was market neutral, one that didn't force him to predict where the whole market was headed. And his solution? He started trading what he called sister stocks.
The logic behind it was, just beautiful in its simplicity. Instead of trying to predict the entire S&P 500, you just bet on the relationship between two stocks getting back to normal. So you find two companies that are somehow deeply linked, you wait for one to get a little ahead of the other, and then you place a bet that they're going to snap back together. It's simple, it's elegant, and it was all born from a desire to stop drawing so many charts.
But that raises a big question, right? How do you go from a trader's gut feeling about sister stocks to a real, data-driven strategy that's powerful enough for today's algorithms? Well, you have to find a way to mathematically define that relationship. You've got to find true financial twins, not just, some distant cousins.
So the very first, most basic check you can do is correlation. It's really just asking a simple question. Do the prices of these two stocks tend to move in the same direction at roughly the same time? A high correlation, well, that's your first clue. It's the first hint that you might have found a pair worth looking at.
But here's the catch. Correlation can be a bit of a trickster. It can show up just by random chance and then disappear just as quickly. The real goal, the holy grail here, is to find co-integration. That means there's a stable, long-term economic link between them. It's like they're attached by a rubber band. Even if they wander off on their own for a little while, some fundamental economic force is always going to pull them back together.
And this is the crucial part. We're looking for pairs where we can pretty reliably express the price of one stock as a simple function of the other. This little formula right here, it basically represents their long-term equilibrium. And when the actual price of stock A drifts too far away from what this formula predicts it should be, boom, that's your trading signal.
So finding a relationship is one thing, but how do you know it's actually real? How do you know it's not just some random statistical fluke that happened to look good on one particular chart you were looking at? How do you make sure it's a real, persistent signal?
Right, modern algorithms can't just take a chance and bet on a fluke. They need a way to really stress test this relationship, to see if it holds up under pressure. They have to be sure that this link is a fundamental feature of these two stocks, not just some temporary coincidence.
And this leads to this really clever technique called a multi-time frame filter. The algorithm basically acts like a skeptical detective. It asks, okay, does this relationship hold up on a 5-minute chart? Yep, okay, good. Now, what about a 15-minute chart? And how about a 30-minute one? Only the pairs whose connection stays strong across all these different zoom levels are considered stable enough to even be considered.
Okay, so once you have these basic tools, a kind of philosophical debate starts to emerge among the quants. What's the best way to find good pairs? Should you cast a really wide net, or do you start with impossibly high standards right from the get-go?
On one side, you've got the relaxed discovery approach. This strategy uses really loose criteria to just scoop up thousands of potential candidates, and the plan is to sort them out and optimize them later. But on the other side, you've got the strict quality approach. This one uses a brutal gauntlet of tests right from the beginning to find only the absolute, undisputed best of the best pairs.
So what does this gauntlet actually involve? I mean, we're not talking about one or two simple checks here. It's a whole battery of advanced statistical tests, and each one is designed to attack the potential relationship from a different angle to try and expose any weakness.
And this is way beyond just checking the basics. Algorithms test for things like rolling stability, making sure the connection didn't just exist last year, but that it holds up consistently, month after month. They use powerful tools like distance correlation to find more complex, even curved relationships that a simple straight-line check would completely miss. And maybe most importantly, they ask a very practical question. After all the trading fees and transaction costs, is there any actual profit left? Only the strongest, most consistently profitable pairs can survive this whole ordeal.
So the modern approach isn't really about choosing one philosophy over the other. It's about combining them into this incredibly powerful multi-stage filtering funnel that starts out super wide and ends up incredibly narrow. Think about it. When you start with a universe of, say, 10,000 stocks, the number of potential pairs you can make is just staggering. We're talking almost 50 million. It is the classic needle in a haystack problem. The algorithm's entire job is to sift through this mountain of data to find those few golden needles.
So we begin with this massive universe of nearly 50 million potential pairs. Now just watch how quickly that number shrinks as we start applying our increasingly strict filters.
The very first filter, just a basic check for correlation, is absolutely ruthless. It throws out over 99% of all possibilities, instantly chopping the pool down from 50 million to just 500,000. And that's a massive cut. But believe it or not, we're only just getting started.
Next up is that multi-time frame filter we talked about. This test for stability cuts the remaining group by more than half again, bringing us down to 200,000. So now we're not just filtering for a connection, we're filtering for an enduring one.
And finally, the full statistical gauntlet is unleashed. After testing for co-integration, long-term stability, and real-world profitability, the number just plummets. From almost 50 million potential pairs, we are left with a tiny elite group of fewer than 100. It's just incredible.
The final step is to rank these elite survivors. A composite score is created, weighting all the factors we've discussed. And what's most important? Well, it's the strength of that economic link, the co-integration, and the speed at which the prices tend to snap back together, which is known as the half-life. This final ranking is what separates the truly exceptional pairs from the merely good ones.
So really, the big takeaway here is seeing how a simple, century-old idea, Livermore's lazy shortcut, has completely evolved. It's now this highly sophisticated, data-driven process that systematically hunts for a stable, tradable signal in a world just filled with overwhelming market noise.
And all of this leaves us with a final big question. As this technology gets better and better at finding these hidden relationships and then trading on them, are we actually stripping out all the market's inefficiencies? Are we making it more rational? Or are we just discovering new, deeper layers of complexity that we haven't even begun to understand yet?